One single copper mine in Chile's desert generates more revenue every single year than the entire GDP of countries like Nicaragua or Madagascar. In 2007 alone, Escondida produced copper worth $10.12 billion. That's $27.7 million in revenue every single day for 365 days straight. While you're watching this video, this mine is extracting copper worth approximately $1.15 million every single hour, around the clock, non-stop. This isn't some ordinary mining operation. Escondida is the world's largest copper mine, and in 2023 it pulled 1,055,000 metric tons of copper out of the ground. That's enough copper to wire 28 million average American homes, or build 21 million electric vehicles. This single mine controls approximately 5% of the entire global copper supply, making it more strategically important to the world economy than you might imagine. Located 170 kilometers southeast of Antofagasta in Chile's Atacama Desert and an elevation of 3,050 meters above sea level, Escondida operates in one of the driest places on Earth. The name Escondida means hidden in Spanish, and it's called that because the massive copper deposits lie buried under hundreds of meters of barren rock, completely invisible from the surface. 5 mining companies had previously held this ground, and not one of them drilled a single hole before 1981. The mine is owned by a joint venture. BHP holds 57.5%, Rio Tinto owns 30%, and Japan's GECO Corporation controls the remaining 12.5%. This ownership structure has remained remarkably stable since the mine's development in the late 1980s and early 1990s, when BHP acquired its majority interest. Together, these partners operate what amounts to a copper-producing machine that contributes between 2.5% and 3% of Chile's entire GDP. But here's what makes this story fascinating. This deposit was almost missed entirely. Before we dive into the billions of dollars flowing through this operation today, you need to understand how close the world came to never discovering this copper giant. And that discovery story involves one geologist, a hunch about superleaching, and a drill hole that almost didn't happen. But I'm getting ahead of myself. Let me show you the numbers first, then we'll come back to how this nearly got passed over. In the fiscal year ending June 2024, Escondida alone produced approximately 1.1 million metric tons of copper. To put that in perspective, using current market prices around $5.60 per pound, that's roughly 2.43 billion pounds of copper annually. At late 2024 prices, that's approximately $13.6 billion worth of copper produced in a single year from one mine. Now, BHP doesn't break out Escondida's specific revenue in isolation because it's part of their broader Chilean operations, but we can calculate the scale. In 2007, when copper prices averaged $3.23 per pound, and Escondida produced 1.483 million tons, the mine generated $10.12 billion in sales. The mine's operating costs that year? Just 60.8 cents per pound. That's a profit margin that would make tech companies jealous. The 2017 strike at Escondida tells you everything about this mine's global importance. When 2,400 union workers walked off the job on February 9, 2017, copper prices worldwide immediately spiked. The strike lasted 44 days, the longest private sector mining strike in Chilean history. It cost BHP $740 million in direct losses and caused a 1.3% contraction in Chile's entire national GDP. Think about that. One mine going offline for 44 days shrinks the economy of a nation by 1.3%. During that strike, Escondida failed to produce more than 120,000 tons of copper. Global copper prices surged from around $6,600 per ton in early 2017 to over $7,000 per ton by July, demonstrating how a single facility can move world markets. This wasn't just a labor dispute, it was a geopolitical event affecting everyone from Chinese electronics manufacturers to American construction companies. Let's establish exactly where all this copper is coming from. Escondida currently operates two massive open-pit mines, the main Escondida pit and Escondida Norte, which began production in 2005. These pits feed into three concentrator plants with a combined processing capacity exceeding 422,000 tons per day of ore. The mine also operates two leaching facilities, one for oxide ore and one for sulfide ore, using bacterial leaching technology. According to BHP's technical report, effective June 2022, Escondida's combined proven and probable ore reserves stand at 3,560 million tons, grading 0.59% copper. That's 3.56 billion tons of proven, economically extractable ore. At 0.59% copper grade, that means approximately 21 million tons of copper metal contained in proven reserves. At current copper prices around $12,500 per ton, that's roughly $262.5 billion worth of copper still in the ground. But that's just proven reserves, the stuff that's economically viable to extract right now with current technology and prices. The mine's measured and indicated mineral resources total 1,640 million tons at 0.49% copper. The inferred resources, copper that geologists are reasonably confident exists, but haven't fully drilled out yet, stand at 5,380 million tons at 0.53% copper. We're talking about a deposit that could potentially contain over 28 million additional tons of copper beyond the proven reserves. The mine currently extracts and processes approximately 370 million tons of material annually. That's roughly 1 million tons every single day being blasted, hauled, and processed. To put that in perspective, if you loaded that daily tonnage into standard dump trucks, the line would stretch from Santiago to Buenos Aires and back, every single day. Here's where the economics get really interesting. In 2023, Escondida's copper production increased by 5% to 1,055,000 tons, primarily due to higher concentrator feed grade of 0.82%, compared to 0.78% in 2022. Even a 0.04% improvement in ore grade translated to tens of millions of dollars in additional revenue. That's the scale we're operating at here. Fractions of percentage points in ore grade equal the GDP of small towns. Since production began in November 1990, Escondida has delivered 38 million tons of copper to global markets. That represents approximately 7% of all global copper mine output over that period. Think about every copper wire, circuit board, electric motor, and building wire installed anywhere in the world since 1990. 1 out of every 14 used copper from this single location in Chile's desert. The mine employs approximately 2,400 unionized workers directly, plus another 3,000 to 4,000 contractors, bringing total employment to around 6,000 people. But that's just direct employment. When economists calculate the full economic impact, including suppliers, service providers, and induced economic activity, Escondida supports tens of thousands of jobs across Chile. The multiplier effect is enormous. Now let's go back to 1978, because understanding how this deposit was discovered makes the current operation even more remarkable. In October 1978, geologist J. David Lowell proposed that Utah International Incresin and Getty Oil Company form a joint venture to explore the northern segment of Chile's porphyry copper belt. This wasn't random speculation. Lowell had studied the pattern of known copper deposits between El Salvador and Chuquicamata and suspected there were more hidden beneath the desert floor. The exploration strategy was brilliant in its simplicity and terrifying in its risk. Rapid geological reconnaissance, semi-detailed geochemical sampling of prospective anomalies, followed by prompt low-cost air rotary drilling of the most favorable targets. They called it the Atacama Project. Field work commenced in January 1979, with teams fanning out across one of the most hostile environments on Earth. The exploration team detected about 30 copper-molybdenum-zinc geochemical anomalies across northern Chile, but only 10 proved significant enough to warrant drilling. One of these anomalies, located in the Escondida area, stood out, but for the wrong reasons. The surface showed the right kind of alteration patterns you'd expect above a porphyry copper deposit, but it had almost no visible copper mineralization at the surface. Here's the crucial detail that almost killed the project. The extremely arid conditions in the Atacama Desert had caused what geologists call super leaching. This superficial weathering process had destroyed the diagnostic textures that would normally signal buried copper deposits. The surface rock was so thoroughly leached that copper content was barely to moderately anomalous, not the strong signal you'd normally want before spending money on expensive drilling. But Lowell and his team noticed something odd. The surface rocks contained anomalously high molybdenum but weak copper values, and the rocks were almost totally replaced by salt, a phenomenon his colleague termed superleaching. Lowell had only a hazy understanding of this process at the time, but it provided a potential explanation for why the surface had molybdenum, but little copper. And it might, just might, mean there was copper underneath. On March 14, 1981, everything changed. Drill hole RDH-6, also called Pozo 6, or Hole 6, was the last scheduled borehole in the program. The drill bit pushed through 241 meters of thoroughly leached caprock. Then, at approximately 240 meters depth, it hit 51 meters of ore, grading 1.51% copper. Follow-up drilling confirmed what they'd found. Hole RDH-7 intersected 73 meters at 0.68% copper and 55 meters at 1.52% copper. Hole RDH-61 cut through 250 meters grading 3% copper. By the end of 1983, they had delineated an initial ore reserve estimate of 1.7 billion tons at 1.59% copper. To give you a sense of scale, that initial estimate alone contained approximately 27 million tons of copper metal. At 1981 copper prices, that was already worth tens of billions of dollars, but this was just the beginning. In 1984, BHP acquired Utah International and, through subsequent transactions involving Texaco's purchase and resale of Getty's interest, gained majority control of the project. A formal joint venture was established in 1985 among BHP at 57.5%, Rio Tinto at 30%, GECO at 10%, and the World Bank's International Finance Corporation at 2.5%. In 2010, GECO acquired the IFC's 2.5% stake, bringing their total to 12.5%. Construction began in 1988, and it was massive. The project required stripping over 180 million tons of waste rock just to access the ore body. That's removing a mountain before you extract a single ounce of valuable ore. The initial capital investment ran into the billions. The Los Colorados concentrator, with a design capacity of 35,000 tons per day, started up in November 1990. The first copper concentrate shipment left Chile by the end of that year. Now here's what separates world-class mining operations from ordinary ones: continuous expansion. Escondida didn't just start producing and coast, it grew aggressively. In MID-1993, the Phase 1 expansion increased Los Colorados' processing capacity from 35,000 tons per day to 37,500 tons per day. Phase 2 in August 1994 took it to 55,000 tons per day. Phase 3 in August 1995 jumped capacity to 105,000 tons per day. By 1998, it reached 127,000 tons per day. Also in 1998, the oxide ore processing plant began operations with a design capacity of 125,000 tons per year of electrolytic copper cathode. The $1.044 billion two-phase 4 concentrator, completed in September 2002, added 110,000 tons per day of processing capacity using retained earnings, meaning the mine was so profitable it funded a $1 billion expansion from its own cash flow. In 2006, construction began on the Sulfide bioleach plant, designed to produce 180,000 tons per year of copper cathode using bacterial-assisted leaching on low-grade run-of-mine ore, This $870 million facility began production in 2007, demonstrating how mining technology can economically extract copper from ore that would have been worthless waste rock just decades earlier. The 2012 investments tell you everything about this mine's cash-generating capacity. BHP Billiton announced $3.8 billion for the Organic Growth Project 1, which involved replacing the Los Colorados concentrator with a new 152,000 tons per day plant to access higher-grade ore located underneath the existing facilities. Construction began in February 2012, and the plant was commissioned in May 2015. The third copper concentrate plant, inaugurated in 2016, increased overall copper processing capacity to over 422,000 tons per day, more than 12 times the original 1990 capacity. That's not incremental improvement, that's transformational growth. The mine had essentially been rebuilt and expanded to become a completely different scale of operation. But expansion on this scale created a critical problem: water. Operating in the Atacama Desert, the driest place on Earth, presents challenges that don't exist at mines in wetter climates. From 1998 to 2019, Escondida extracted fresh water from a well field in the Monturaqui area of the Monturaqui-Negrear-Tilapozo aquifer, located 78 kilometers east of the mine. This well field had an installed capacity to extract 1,400 liters per second, about 44 billion liters annually. The environmental consequences were significant. In 2022, indigenous Atacamano people, along with lithium-extracting company Albemarle and the nearby Zaldivar copper mine, were brought to court over excessive groundwater extraction and associated damages to the environment. The lawsuit alleged harm to meadows at Tilapozo and lakes at La Punta and La Brava, as well as economic and social damage to the indigenous community. Minera Escondida argued that any effects of its water extraction hadn't had time to manifest downstream due to the slow movement of groundwater, and that it was the extraction by other companies that had caused the damage. The lawsuit ended in December 2024 in a conciliation agreement. Minera Escondida and the other two companies agreed to compensate the indigenous Comunidad de Paine economically, socially, and environmentally, plus pay for damages to the meadows and lakes. The first environmental court of Antofagasta ordered Minera Escondida to pay more than $8 million in compensations related to the case. The solution BHP implemented was engineering at extraordinary scale. In 2005, Degermont Industry installed a seawater reverse osmosis desalination plant with capacity to produce 45 million liters per day near Caleta Coloso on the coast. Then, in 2017, a second desalination plant began operations with capacity of 2,500 liters per second. That's 216 million liters per day. As of 2024, Escondida is wholly supplied with fresh water from coastal desalination. The water is pumped uphill over 160 kilometers from sea level to the mine site at 3,050 meters elevation. That's pumping hundreds of millions of liters daily up nearly 10,000 feet. It requires enormous energy, which is one reason why Escondida is one of the largest electricity consumers in Chile, purchasing 3 terawatt-hours annually just for the Escondida and Spence operations. Let's talk about the geopolitical dimensions, because Escondida isn't just economically important to Chile, it's strategically critical to the global economy. Copper is the third most consumed industrial metal after iron and aluminum, and it's irreplaceable in electrical applications. Every electric vehicle requires 80 to 100 kilograms of copper. Every wind turbine uses tons of copper. Data centers, solar farms, grid infrastructure, all utterly dependent on copper. When Escondida accounted for 23.7% of Chile's copper production in the first half of 2024, and Chile itself produces roughly 24% of global copper supply, you can do the math. About 5.7% of all copper entering global markets comes from this single mine. When it goes offline, markets notice immediately. When it strikes, prices spike globally. This gives the mine's workers enormous leverage. That became abundantly clear in August 2024 when workers at Escondida initiated another strike after wage negotiations collapsed. Union Number 1, representing 2,400 workers, had demanded that 1% of shareholder dividends be distributed among workers. That would have amounted to about $36,000 per worker annually, based on the mine's dividend distributions. BHP had offered a signing bonus of $28,900 per worker, plus $2,000 in soft loans. The strike began on Tuesday, August 13, 2024, at 8 a.m. local time. BHP activated contingency plans with non-unionized workers, attempting to maintain scaled-back operations. Goldman Sachs analysts estimated the strike was costing approximately $16 million per day in lost EBITDA. If it had lasted the full 44 days like the 2017 strike, the EBITDA impact would have reached $795 million. But this strike ended quickly. By Friday, August 16, 2024, just 3 days later, BHP and union leaders reached a preliminary wage agreement. The union accepted terms that reportedly included the $32,000 signing bonus that BHP had offered, recognizing that a prolonged strike in a copper market with elevated inventory levels might not achieve their goals. The final agreement included not just economic terms, but substantial improvements in health benefits, worker security, and protections for workers who might lose jobs due to outsourcing. The union's lawyer, Marco Lopez, called it the greatest recent union victory in terms of results, noting that it wasn't just about economics, but about addressing historic demands we hadn't been able to achieve before. Union President Patricio Tapia emphasized the importance of health benefits and job security provisions. Both parties suspended the strike effective Friday, August 16th, and operations returned to normal. Here's what that tells us about labor dynamics in critical commodity mining. When you control 5% of global supply of a commodity with no ready substitutes, your workers have extraordinary bargaining power. Chilean law prevents companies from replacing striking workers, giving unions even more leverage. The global dependency on Escondida's output essentially gives its workforce influence over worldwide commodity prices. Now let's examine the copper market context that makes Escondida's strategic importance even greater. In 2024, copper prices experienced extraordinary volatility, reaching a then-record high of $5.20 per pound in May 2024, before experiencing corrections. Copper then surged to a new all-time high of $5.95 per pound on July 24, 2025, during intraday trading before closing at $5.88. As of late 2024 and early 2025, copper has been trading around $5.60 to $5.70 per pound, up more than 40% year over year. What's driving this? The supply-demand fundamentals are increasingly tight. BHP America's president Brendan Craig told Reuters that the deficit is going to be around 10 million tons by 2035, estimating a $250 billion cost to develop enough new mines to match demand. Think about that number, $250 billion just to prevent a supply shortage. The global energy transition is consuming copper at unprecedented rates. Each electric vehicle requires 80 to 100 kilograms of copper, quadruple what a conventional car needs. A single offshore wind turbine uses 4.7 tons of copper. Solar farms, grid upgrades, data centers, AI infrastructure, they're all copper-intensive. Meanwhile, major copper mines are aging, and grades are declining. Chile's state-owned Codelco saw 2023 production fall to its lowest level in 25 years. First Quantum Minerals' Cobre Panama mine, responsible for nearly 350,000 tons of annual production, was shut down by government order in late 2023. That's 1.5% of global supply removed instantly. Anglo American announced it was scaling back output by approximately 200,000 tons due to grade declines and logistical issues at its Los Bronces mine. The timing couldn't be worse because demand is accelerating. The HP forecasts global copper demand will approximately double over the next 30 years, driven primarily by electrification and technology. The company expects to boost copper production from its Chile operations by 430,000 to 540,000 tons per year, through investments ranging from $10.7 billion to $14.7 billion over the next decade. For Escondida specifically, BHP has announced 4 new projects starting between 2027 and 2032, with peak investments expected during fiscal years 2030 and 2031. These projects are designed to address declining ore grades by expanding processing facilities and implementing advanced copper extraction technologies, including leaching technologies to extract copper from sulfide ores. This is critical because ore grades at Escondida have been declining over time, a natural consequence of mining the richest zones first. In 2022, the concentrator feed grade was 0.78% copper. In 2023, it improved to 0.82%, but the long-term trend is downward unless new high-grade zones are accessed. That 0.82% grade in 2023, by the way, is still excellent compared to many copper mines worldwide. The global average copper ore grade is approximately 0.6% to 0.7%, and many operations work with grades below 0.5%. But here's the thing about Escondida. Even as grades decline, the sheer scale of the operation and the infrastructure already in place make continued investment economically compelling. According to BHP's 2012 estimates, the mine had another 100 years of production potential. That's not a wild guess. It's based on proven reserves, resource estimates, and anticipated mine expansions. The mine life extends past 65 years from the start of operations, meaning production could continue well into the 2050s and potentially beyond. But mine life projections depend on copper prices, extraction technology, and reserve replacement. If copper prices remain elevated, and most analysts expect they will due to supply constraints and electrification demand, lower-grade material becomes economically viable. This extends mine life but requires continued capital investment in processing facilities. Let's talk about what Escondida actually looks like on the ground, because the physical scale is staggering. The 2 open pits, Escondida and Escondida Norte, are massive excavations visible from space. NASA has photographed the mine multiple times, with astronauts capturing images showing the vast impoundment areas for waste material and the geometric precision of the mining benches. Copper concentrates from the processing plants are pumped through a 170-kilometer pipeline to the coastal port of Coloso. That's right, 170 kilometers of pipeline carrying copper concentrate, as slurry, assisted by gravity as it descends, from 3,050 meters elevation to sea level. At Coloso, the concentrate is dewatered using Larox-style PF filters and 4 ceramic hyperbaric filters, which reduce moisture content to an average of 9%. The dried concentrate is then shipped to smelters worldwide, primarily in Asia. Effluent from the dewatering process is treated before discharge deep into the Pacific Ocean, following environmental regulations. The mine has made significant strides in automation and sustainability. According to Minera Escondida, the northern pit known as Rajo Norte began operating exclusively with self-driving trucks in late July 2025. This autonomous haul truck fleet represents a major technological advancement, improving safety and operational efficiency. BHP plans to replace the entire haul truck fleet at Escondida within 10 years starting in 2023, under an agreement with Caterpillar and Finning International signed in August 2022. The mine is also moving toward 100% renewable energy by leveraging Chile's abundant solar and wind resources. This aligns with Chile's Energía 2025 power policy, which calls for 20% of all Chilean energy to come from renewable sources by 2025. For Escondida, this isn't just environmental stewardship, it's economics. Solar energy in the Atacama Desert delivers more than 3 kilowatt-hours per square meter per year, making it one of the best solar resources on Earth. Wind resources are also excellent in the region. Renewable energy reduces operating costs and insulates the mine from fossil fuel price volatility. The mine received the Copper Mark certification in November 2021 after undergoing an independent assurance process. This symbol of ethical production practices matters increasingly to downstream buyers, particularly in electric vehicle and renewable energy sectors, where supply chain transparency is demanded. Let's put Escondida's production in global context. In 2023, global copper mine production totaled approximately 22 million tons. Escondida's 1,055,000 tons represented roughly 4.8% of world output from a single facility. Chile as a whole produced approximately 5.3 million tons in 2023, meaning Escondida accounted for nearly 20% of Chilean production. The next largest copper mines globally include Collahuasi in Chile, which produced 573,200 tons in 2023, and Buenavista in Mexico. Even Collahuasi, jointly owned by Anglo American and Glencore, produces only about 54% as much copper as Escondida. That's the definition of dominance. No other copper mine comes close to Escondida's output. The strategic implications extend beyond tonnage. Escondida's ore contains not just copper but also gold and silver. In 1999, the mine produced 150,000 ounces of gold and 3.53 million ounces of silver. While these byproduct metals represent a small fraction of revenue compared to copper, they add meaningful value to the operation. The deposit is classified as a copper porphyry, one of the most important copper deposit types globally. Porphyry copper deposits form when magma intrudes into the Earth's crust, cooling slowly and creating networks of fractures that get filled with copper-bearing minerals. The mineralization at Escondida is divided into two main components: a low-grade primary sulfide component and a high-grade supergene zone. The supergene enrichment occurred when copper was leached from the surface rocks by groundwater, then redeposited over the primary sulfide ore, creating a second layer of copper mineralization. It's this process and the preservation of the supergene caps in the arid environments that creates these massive copper resources. The arid conditions also preserved a large copper oxide resource formed as the sulfide ore weathered and was redeposited. This geologic story explains why Escondida is so large, perfect conditions for formation, enrichment, and preservation. But geology only explains potential. It takes capital, technology, and operational excellence to turn rock into revenue. Speaking of capital, let's trace the investment history. The cumulative investment by 2006 was $5.64 billion according to financial reports. The $554 million Escondida Ore Access Project approved in 2011 involved relocating, crushing, and conveying facilities inside the main pit to improve access to high-grade ore. In 2012, BHP Billiton invested a total of $2.6 billion in the Organic Growth Project 1 and the Oxide Leach Area Project. The Oxide Leach Area Project created a new dynamic leaching pad and mineral handling system. In 2013, Minera Escondida announced construction of a second desalination plant and awarded the construction contract for the Quellar power plant, which supplies power to Minera Escondida and other BHP mines. The second desalination plant started operations in 2017 with capacity of 2,500 liters per second. These investments, totaling over $10 billion over the mine's lifetime, demonstrate that Escondida isn't a passive asset. It requires continuous capital reinvestment to maintain and grow production, access deeper or lower-grade ore, improve efficiency, and meet environmental standards. But here's the key. Escondida generates enough cash flow to fund these investments and still return billions to shareholders. In the second half of 2023 alone, BHP made a profit of $6.6 billion across all operations. While this isn't Escondida-specific, the Chilean copper assets are core to BHP's profitability. BHP produced 1.8 million tons of copper in the financial year ending June 2024, the majority from its two Chilean mines, Escondida and Pampa Norte. Escondida's contribution of approximately 1.1 million tons represents about 61% of BHP's total copper production. For Rio Tinto, which owns 30% of Escondida, the mine is similarly critical. Rio Tinto's share of mined copper production from Escondida was 300,000 tons in 2023, flat from the previous year. That represents a significant portion of Rio Tinto's copper production and cash flow. For GECO Corporation, the Japanese consortium consisting of Mitsubishi with 70% ownership, Nippon Mining and Metals with 20%, and Mitsubishi Materials with 10%, Escondida secures long-term copper supply for Japanese industry. This is strategic resource control at work. Japan has virtually no domestic copper resources, so equity stakes in major overseas mines guarantee supply access. The joint venture is managed by a 7-person owners' council, designated by the 4 owners. Major decisions require consensus among shareholders, proportional to their stakes. BHP, with 57.5%, has operational control and manages day-to-day activities including production, maintenance, and capital investments. This governance structure has proven remarkably stable over decades. Now let's address the controversies and challenges, because no operation this large exists without conflict. Beyond the water extraction lawsuit, Escondida has faced labor disputes, environmental scrutiny, and community tensions. The 2006 strike was another significant event in the mine's history. Workers felt they weren't sharing in the very high profits being made by the company on the back of record copper prices. The strike lasted 25 days and demonstrated early on that labor relations would be a recurring challenge. In 2011, there was another strike. In 2015, workers again walked off the job. Then came the massive 44-day strike in 2017. Each time, the pattern is similar. Copper prices rise, the mine generates enormous profits, workers demand a larger share, negotiations break down, production halts, global markets react. The August 2024 strike, though it lasted only 3 days, followed the same template. Chilean labor law gives workers significant protections, and the strategic importance of Escondida gives them leverage that workers in less critical industries simply don't have. Environmental challenges go beyond water. Mining at this scale generates massive amounts of waste rock and tailings. The impoundment areas for these materials are enormous, and managing them safely requires sophisticated engineering and ongoing monitoring. Dust control in the desert environment is another issue. The mine must prevent wind-blown dust from affecting nearby communities and ecosystems. The mine has implemented extensive dust suppression measures, but this is an ongoing operational requirement. Tailings management has become increasingly important globally after several catastrophic tailings dam failures at other mines worldwide. While Escondida hasn't experienced such a failure, the risk is always present and requires constant vigilance, investment in dam maintenance, and adherence to best practices. The social license to operate, the community acceptance of mining activity, must be continuously earned. Local indigenous communities, environmental groups, and regional governments all have stakes in how the mine operates. Minera Escondida engages with these stakeholders, but tensions inevitably arise when a massive industrial operation exists in proximity to communities and fragile desert ecosystems. The mine contributes significant tax revenue to Chile. In 2007, the operation paid $2.2 billion in taxes to the Chilean treasury. That's not a trivial sum. It funded schools, hospitals, infrastructure, and government services nationwide. But communities near the mine often feel they bear the environmental and social costs while benefits flow elsewhere. This is a classic resource extraction tension: global benefits, localized impacts. BHP and its partners have attempted to address this through community investment programs, local employment, and environmental mitigation. Whether these efforts are sufficient is a matter of ongoing debate among stakeholders. Let's shift to the future, because what happens next at Escondida will shape global copper markets for decades. The announced investment of $10.7 billion to $14.7 billion over the next decade signals BHP's commitment to sustaining and potentially growing production. The 4 new projects starting between 2027 and 2032 are designed to offset grade decline and access new ore zones. One key challenge is the eventual closure of the Los Colorados concentrator, which has been operating since 1990. Replacing or upgrading this facility is part of the long-term plan. BHP's strategy of fewer but larger assets makes sense when you have a world-class operation like Escondida. Rather than explore for new deposits in uncertain jurisdictions, concentrate capital on extending the life and production of proven assets. The expected boost of 430,000 to 540,000 tons per year from Chilean operations would be transformational. If Escondida contributed even half of that increase, it would push annual production back toward the 1.4 million ton capacity achieved during peak years. At current copper prices around $12,500 per ton, an additional 250,000 tons of annual production would generate roughly $3.1 billion in additional revenue per year. The investment to achieve that, perhaps $5 billion to $7 billion, allocated to Escondida, would pay for itself in under 3 years at current prices. That's the kind of return on investment that makes mining executives salivate. Of course, these plans face risks, permitting delays, construction cost overruns, technical challenges, further labor disputes, changing environmental regulations, and copper price volatility. But BHP has a 34-year track record of successfully operating and expanding Escondida. They know this ore body better than anyone on Earth. The technological investments are equally important. The shift to autonomous trucks improves safety by removing workers from hazardous pit operations. It also increases efficiency. Autonomous trucks don't take breaks, don't get tired, and can operate 24/7 with optimal route planning. The move to renewable energy reduces operating costs and carbon emissions. As climate regulations tighten globally and carbon taxes become more common, low-carbon copper will command premium prices from environmentally conscious buyers. Tesla, for example, scrutinizes its supply chain for environmental and social performance. Copper from Escondida certified under the Copper Mark and produced with renewable energy becomes more attractive to such buyers. Advanced leaching technologies that extract copper from sulfide ores expand the range of material that can be economically processed. Historically, sulfide ores required smelting, but bacterial leaching allows on-site copper recovery. This technology, which Escondida deployed in 2007, turns low-grade material that would sit in waste dumps into revenue-generating ore. As higher-grade primary ore depletes, these technologies become increasingly important to maintaining production. Water management will remain critical. The desalination plants provide security, but they're energy-intensive. Pumping water 170 kilometers uphill requires significant electricity. As the mine expands, water demand will grow. BHP may need to invest in additional desalination capacity or implement more aggressive water recycling technologies. Every drop of water is precious in the Atacama, and efficient use isn't optional. It's existential. Looking at the global copper market, analysts are nearly unanimous that prices will remain elevated for years. Goldman Sachs has forecast copper could reach $6 to $7 per pound. That would represent a 20 to 40% increase from current levels around $5.60. At $7 per pound, Escondida's annual production of 1.1 million tons would be worth approximately $17 billion. The implications are staggering. More cash flow, more dividends, more tax revenue, more worker bonuses, more reinvestment. But high prices also attract new supply. Mining companies worldwide are racing to bring new copper projects online. The challenge is that major copper deposits are increasingly rare, and developing them takes 10 to 20 years from discovery to production. That long lead time means the supply deficit forecast by BHP for 2035 is likely real. There simply aren't enough projects in the pipeline to meet demand growth. This structural supply shortage is why Escondida matters so much. It's one of the few truly world-class copper deposits in production today. Losing even 10% of its output would be felt globally. Maintaining production at Escondida isn't just important for BHP, Rio Tinto, GECO, and Chile. It's critical for the global energy transition. Here's something most people don't realize. The copper coming out of Escondida today might end up in a Tesla manufactured in Shanghai, a wind turbine installed offshore Denmark, a solar farm in Texas, or data center in Virginia. This single mine in Chile's desert is physically enabling the electrification of the global economy. Without Escondida's 5% of global supply, electric vehicle production would be constrained, grid expansions delayed, renewable energy projects shelved. The green energy transition requires copper in quantities the world has never produced before. Escondida is one of the few assets that can deliver at the necessary scale. That's the ultimate irony. A massive open-pit mine in one of Earth's most pristine deserts, consuming enormous amounts of energy and water, is essential to building a sustainable energy future. The world needs copper for sustainability, and Escondida is the world's largest copper mine. Let's bring this back to the money, because ultimately Escondida is a financial machine that happens to mine copper. Since beginning operations in 1990, the mine has generated cumulative revenue exceeding $250 billion based on historical copper prices and production. That's $250 billion in sales from one location. The return on the initial capital investment of several $billion is almost incomprehensible. Early investors in the joint venture have seen returns that dwarf virtually any other investment opportunity. BHP's acquisition of Utah International in 1984, which brought them control of Escondida, might be one of the greatest mining acquisitions in history. For Chile, Escondida has been transformational. The mine has paid tens of billions in taxes over its lifetime. It employs thousands directly and tens of thousands indirectly. It anchors the economy of the Antofagasta region. When you land at Antofagasta Airport, drive through the city, see the port facilities at Coloso. You're witnessing an economy built on copper. Escondida isn't just a contributor, it's the foundation. The 2.5% to 3% of national GDP that Escondida represents might not sound enormous, but remember that's from one facility. Chile's GDP in 2023 was approximately $335 billion. 3% of that is over $10 billion contributed by a single mine. That's equivalent to what some entire industries contribute to national output. For comparison, agriculture contributes about 3 to 4% of Chile's GDP, and that's from thousands of farms across the entire country. One mine matches an entire economic sector. The geopolitical implications extend to China, which is the world's largest copper consumer. China accounts for roughly 50% of global copper demand. Much of Escondida's copper concentrate is shipped to Chinese smelters. This creates interdependence. Chile needs Chinese demand for its copper. China needs Chilean copper for its economy. Any disruption to this flow, whether from labor strikes, political conflicts, trade restrictions, or natural disasters, affects both nations. The United States has also recognized copper as a critical mineral, essential to national security and economic competitiveness. The U.S. Geological Survey monitors global copper production closely. The Biden administration's infrastructure investments and push for domestic EV manufacturing have increased U.S. copper demand. Yet the U.S. produces less than 5% of global copper and must import the majority of what it consumes. Escondida's output, while it doesn't directly supply the U.S. in large quantities, affects global pricing and availability. When Escondida strikes, U.S. manufacturers pay more for copper. When Escondida expands, global supply tightness eases slightly. That's the nature of globally traded commodities. A mine in Chile affects prices in Detroit. The competitive landscape in global copper mining reveals why Escondida's position is so secure. Collahuasi, also in Chile, is the second largest copper mine, but produces only 573,200 tons annually, nearly half of Escondida's output. Sulawesi has one of the largest copper reserves in the world, estimated at 3.93 billion tons, grading 0.66% copper, and is jointly owned by Anglo-American and Glencore, with 44% each. Yet despite massive reserves comparable to Escondida, its annual production remains significantly lower. This highlights how infrastructure, processing capacity, and operational efficiency matter as much as raw geology. Mexico's Buena Vista mine experienced a 13.5% decrease in production in 2023, mainly driven by lower ore grades and recoveries according to owner Southern Copper Corp. These grade declines are affecting mines worldwide, making Escondida's 0.82% grade in 2023 increasingly valuable. Chile's state-owned Codelco, the world's largest copper producer by total output across multiple mines, saw 2023 production hit its lowest level in 25 years. All four of Codelco's megaprojects have faced delays, cost overruns totaling billions of dollars, and operational problems while failing to deliver promised production boosts. This context makes Escondida's consistent performance even more remarkable. The mine has navigated grade declines, labor disputes, water challenges, and environmental pressures while maintaining production above 1 million tons annually. Peru, the world's second-largest copper producer after Chile, has seen its own challenges. The Las Bambas mine in Peru experienced a strike that temporarily halted shipments, removing significant tonnage from global markets. First Quantum Minerals' Cobre Panama closure in late 2023 removed nearly 350,000 tons of annual production. That's equivalent to wiping out a major mine overnight. These supply disruptions explain why copper prices surged in 2024 and 2025. The market is increasingly tight, inventories are drawn down during each disruption, and there's limited spare capacity to compensate. Escondida's reliability becomes more valuable every time another major mine faces problems. When you control 5% of global supply and maintain consistent output, you set the floor for global prices. Looking at the downstream markets, electric vehicle production provides the clearest demand driver. In 2023, global EV sales reached approximately 14 million units. Each vehicle requires 80 to 100 kilograms of copper. That's 1.12 to 1.4 million tons of copper annually just for EVs. By 2030, many analysts forecast EV sales could reach 40 million units annually. That would require 3.2 to 4 million tons of copper per year for EVs alone, equivalent to 3 times Escondida's current annual production. And that's just one demand sector. Renewable energy infrastructure requires even more copper per installed capacity. A single 3-megawatt offshore wind turbine uses approximately 4.7 tons of copper. Global wind capacity additions in 2023 were approximately 117 gigawatts. At an average of 3 megawatts per turbine, that's roughly 39,000 turbines, requiring about 183,000 tons of copper. Solar installations, while less copper-intensive per megawatt than wind, still add significant demand. Grid infrastructure upgrades to handle renewable energy add even more. The International Energy Agency estimates that achieving net zero emissions by 2050 would require global copper demand to double from current levels. That's an additional 25 million tons of annual demand that must come from somewhere. Data centers are another massive and growing copper consumer. A single large data center can contain 5,000 kilometers of copper cable. With AI driving explosive data center construction globally, this demand vector is accelerating faster than most forecasts predicted. The construction sector, historically copper's largest market, continues growing as urbanization expands in developing economies. China alone accounts for approximately 50% of global copper consumption, with construction and infrastructure as primary end uses. Any economic stimulus in China immediately affects global copper demand. The stimulus measures announced by China in late 2024 helped drive copper prices higher as markets anticipated increased infrastructure spending. This creates a feedback loop. Higher copper prices increase Escondida's revenue, which increases Chile's GDP, which increases tax revenue, which funds more government spending, which creates more economic activity. The mine isn't just participating in the economy, it's actively shaping macroeconomic conditions. Chile's export earnings are approximately 60% dependent on copper sales. When copper prices rise from $4 to $5.60 per pound, a 40% increase, Chile's export revenues surge by tens of billions of dollars annually. This affects the Chilean peso exchange rate, inflation dynamics, government budgets, and political stability. Escondida's importance to Chile cannot be overstated. The mine site itself spans approximately 178 square kilometers of area, with mineral rights under mining lease. Active mining areas are located on various parcels of land, at an average elevation of 3,100 meters above mean sea level. The two open pits, Escondida and Escondida Norte, are separated by approximately 5 kilometers. Extraction begins with drilling vertical or angled holes into the rock, which are then loaded with explosives and blasted. The blasted material is loaded by large electric shovels into haul trucks for transport to either the processing facilities or waste dumps. The mine operates 24 hours a day, 365 days a year. Production never stops. Even during shift changes, meal breaks, and maintenance periods, some portion of the operation continues running. This continuous operation is critical to achieving the enormous tonnage throughput. Processing 370 million tons annually means processing approximately 1.01 million tons every single day without exception. That's 42,000 tons per hour, or 700 tons every single minute. Imagine a fully loaded haul truck being processed every 30 seconds, around the clock forever. The 3 concentrator plants use flotation technology to separate copper minerals from waste rock. Crushed ore is ground to fine powder mixed with water and chemicals, then agitated in flotation cells. Copper minerals attach to air bubbles and float to the surface as froth, while waste rock sinks. The copper-rich froth is collected, filtered, and dried to create copper concentrate. This concentrate typically contains 25 to 30% copper, compared to the original 0.82% in the ore, a massive enrichment achieved through physical and chemical processing. The concentrate is then pumped as slurry through the 170-kilometer pipeline to Coloso. The engineering of this pipeline is remarkable. Pumping slurry, 170 kilometers, requires careful management of flow rates, density, and particle size to prevent blockages. The pipeline operates continuously, delivering concentrate to the port at a rate that matches the mine's production. At the port, dewatering reduces moisture content to approximately 9%, creating a product that can be shipped without degradation. The dried concentrate is loaded onto bulk carrier ships for transport to smelters, primarily in Asia. Shipping logistics are carefully coordinated because any disruption to the concentrate flow creates bottlenecks. The mine produces more concentrate than it can immediately ship, so storage facilities at Coloso provide buffer capacity. During the 2017 strike, these storage facilities filled up, and the pipeline had to be shut down because there was nowhere to send the concentrate. This interconnected system, mine, processing plants, pipeline, port, storage, shipping, must work in perfect synchronization. A failure at any point cascades through the entire operation. The financial metrics of copper mining reveal why Escondida is exceptional. Most copper mines worldwide operate with all-in sustaining costs between $2.50 and $3.50 per pound. Escondida's costs in 2007 were just 60.8 cents per pound. Indirect costs, though all-in sustaining costs, including capital expenditures, would be higher. Even accounting for cost inflation since 2007, Escondida remains one of the lowest-cost major copper producers globally. This cost advantage stems from scale. spreading fixed costs across enormous production volumes, and grade where even 0.82% copper is excellent by global standards. When copper prices hit $5.60 per pound and your costs are $2.50, you're generating $3.10 per pound in margin. Multiply that by 2.43 billion pounds annually, and you get $7.5 billion in annual cash margin. That's before accounting for byproduct credits from gold and silver, which further reduce net costs. This cash generation capability explains why BHP can fund billion-dollar expansion projects from retained earnings. The mine pays for itself and then generates surplus capital that can be reinvested or returned to shareholders. In practical terms, at current production rates and prices, Escondida generates enough cash to fund its own expansion every 18 to 24 months. That's the definition of a cash-generating machine. The dividend implications for shareholders are substantial. BHP's total dividend payments to shareholders depend on overall company performance, but Chilean copper operations are core contributors. When workers demanded 1% of shareholder dividends in 2024, they were asking for approximately $36,000 per worker based on Escondida's proportional dividend distribution. That implies total dividends attributable to Escondida of roughly $3.6 billion annually at the time. For Rio Tinto holding 30% of Escondida, that would represent approximately $1.08 billion in annual dividend income from their stake. For Geco Corporation's 12.5% stake, roughly $450 million annually. These aren't trivial sums, they're meaningful portions of these companies' total cash flows. The stability of Escondida's dividend stream provides predictable returns that support these companies' own dividend payments to their shareholders. Pension funds, sovereign wealth funds, and retail investors holding BHP or Rio Tinto shares indirectly benefit from Escondida's profitability. The mine's cash flows ripple through global capital markets. The taxation structure in Chile ensures the government captures significant value. Chile's mining tax regime includes corporate income tax, mining royalties based on production volumes, and specific mining taxes that escalate with profitability. In 2007, when Escondida paid $2.2 billion in taxes on revenue, of $10.12 billion, the effective tax rate was approximately 21.7%. This doesn't include value-added taxes, import duties, payroll taxes, and other levies. The total government take from Escondida likely exceeds 30% to 35% of revenue when all taxes and fees are included. For comparison, many oil-producing nations capture 60% to 80% of resource rents, so Chile's regime is relatively moderate. This balance between government revenue and company profitability has remained stable for decades, contributing to Chile's reputation as a mining-friendly jurisdiction. Investors know the rules. The rules don't change capriciously, and the government captures fair value without killing the golden goose. The historical production record shows remarkable consistency despite challenges. From 1990 to 2023, Escondida has maintained average annual production above 1 million tons, with few exceptions. The 2017 strike year saw reduced production due to the 44-day stoppage, but the mine quickly ramped back to full capacity. The COVID-19 pandemic in 2020 caused disruptions worldwide, yet Escondida maintained operations with enhanced safety protocols. Road blockades in December 2022, as part of civil unrest across Chile, reduced availability of some key mine supplies and affected production temporarily. These disruptions demonstrate the mine's vulnerability to external factors beyond management control. Yet the overall trend is upward production, improved recovery rates, and continuous optimization. The 2023 production of 1,055,000 tons represented a 5% increase from 2022, showing the mine's ability to grow output even after 33 years of operation. The BHP's production guidance for Escondida in 2024 estimated between 1,080,000 and 1,180,000 metric tons, suggesting confidence in continued strong performance. Achieving the top end of that guidance would match or exceed historical peak production levels. The concentrate quality from Escondida is another often overlooked advantage. Concentrate grading 25 to 30% copper is among the highest in the industry. Some mines produce concentrate grading only 20% to 23% copper, which means more impurities and lower smelter payments. Smelters pay for copper content but charge treatment and refining fees that increase with impurity levels. High-quality concentrate from Escondida commands premium treatment terms from smelters, improving net realized prices. In tight markets, smelters compete for high-quality feed, which can reduce treatment charges and increase the mine's profitability. The treatment and refining charges that Escondida paid in 2007 were sharply lower than previous years due to smelter competition for feed. This directly boosted profitability. Every dollar saved in treatment charges is a dollar added to the bottom line. The oxide leaching operation at Escondida processes oxide ore that cannot be effectively concentrated through flotation. This ore is stacked on leach pads and irrigated with sulfuric acid solution. The acid dissolves copper from the ore, creating a copper-rich solution that's collected and processed through solvent extraction and electrowinning to produce pure copper cathode. This technology allows economic extraction from ore types that would otherwise be worthless waste. The sulfide leach plant uses bacterial-assisted leaching, a biological process where naturally occurring bacteria help break down sulfide minerals and release copper. This $870 million facility produces 180,000 tons of copper cathode annually from material that couldn't be economically processed any other way. Reserve replacement at Escondida is critical to sustaining production beyond the current mine life estimate. The mine has been producing for 34 years and has delivered 38 million tons of copper. Yet proven and probable reserves still total 3,560 million tons. At 0.59% copper, roughly 21 million tons of contained copper metal. This means the mine has successfully replaced reserves through conversion of resources and new discoveries within the property. Ongoing exploration and delineation drilling continues to convert inferred and indicated resources into proven reserves. As mining advances deeper and into new areas, geologists better understand the deposit geometry and can upgrade resource classifications. The measured and indicated resources of 1,640 million tons at 0.49% copper represent the next tier of material that could be converted to reserves with additional drilling and engineering studies. The inferred resources of 5,380 million tons at 0.53% copper are more speculative, but suggest enormous upside potential. If even half of the inferred resources are eventually converted to reserves, that would add another 14 million tons of copper metal to the mine's inventory. At current production rates of 1.05 million tons annually, that's another 13 years of mine life, just from inferred resources. The geology of the deposit suggests there's more copper present than currently classified in resource estimates. Porphyry copper deposits often extend deeper than initial drilling suggests, and Escondida's mineralization remains open at depth. DHP's exploration team continues drilling to extend the known limits of mineralization and test for additional ore zones. Each successful drill hole that extends the deposit potentially adds millions of dollars to the mine's net present value. The regional economic impact extends far beyond the mine site itself. Antofagasta, the nearest major city, has grown substantially since Escondida began operations in 1990. The port of Coloso, once a minor facility, has been expanded with modern concentrate handling and shipping infrastructure. Local suppliers, service companies, and contractors have built businesses serving the mine. Housing, schools, hospitals, roads, and utilities in the region have all been upgraded to support the mining workforce and their families. This isn't charity, it's necessary infrastructure to attract and retain skilled workers in a remote desert location. The wages paid by Escondida are significantly above Chilean national averages. Mining jobs are among the highest paid blue-collar positions in Chile. The worker at Escondida can earn $50,000 to $80,000 or more annually, including bonuses and overtime, compared to national median income around $20,000. These high wages create local purchasing power that supports restaurants, retail, housing, and services. The multiplier effect means every dollar paid in wages generates additional economic activity as workers spend their income. Economists estimate that each mining job supports 3 to 5 additional jobs in the broader economy through these multiplier effects. So, Escondida's direct employment of 2,400 unionized workers plus 3,000 contractors translates to perhaps 20,000 to 30,000 total jobs when indirect and induced employment are included. For a region with a population of several hundred thousand, this is transformational. Chile's copper industry history provides important context for understanding Escondida's role. Chile has been mining copper for over a century, with major deposits like Chuquicamata and El Teniente operating since the early 1900s. The nationalization of copper mines in the 1970s under President Allende created Codelco, which became the world's largest copper producer through state ownership of formerly private mines. But Chile also maintained a private mining sector and attracted foreign investment through stable mining codes. Escondida represents the success of this hybrid model, foreign companies investing billions in Chilean resources, operating under Chilean law, paying Chilean taxes, employing Chilean workers, and generating wealth that benefits both investors and the nation. This balanced approach has made Chile the dominant copper producer globally. Comparing Chile's 5.3 million tons of copper production in 2023 to global output of approximately 22 million tons, Chile represents 24% of world supply from one country. Peru is second at roughly 2.7 million tons, followed by China at about 1.9 million tons, and the Democratic Republic of Congo at 1.9 million tons. No other nation comes close to Chile's copper output. This concentration of supply in one country creates both opportunities and vulnerabilities. For Chile, copper is economic lifeblood. For the world, dependence on Chilean copper creates supply chain risks. Any political instability, natural disasters, or policy changes in Chile immediately affect global copper availability. The 2019 social protests in Chile, which included road blockades that affected Escondida's supply chains, demonstrated this vulnerability. China's copper smelting capacity far exceeds its mine production, creating dependence on imported concentrate. Chile is China's largest supplier of copper concentrate, making the bilateral relationship strategically critical for both nations. Trade tensions between China and the West could theoretically affect Chilean copper exports, though copper is generally excluded from tariffs due to its critical nature. The Trump administration's threatened tariffs on copper in 2025 created market distortions, but ultimately copper was excluded from levies. This policy recognition reflects the fact that tariffs on critical materials hurt domestic industries more than they help. The United States needs copper for infrastructure, manufacturing, defense, and technology sectors. Taxing copper imports would increase costs for American companies without creating meaningful domestic supply alternatives. The U.S. has limited copper mine production and insufficient smelting capacity to process concentrate, even if mines expanded. Looking at Escondida's competitive moat, several factors make it nearly impossible to replicate. First, the geology. Porphyry copper deposits of this size and grade are extraordinarily rare. Thousands of exploration projects worldwide search for the next Escondida, but discoveries of comparable size occur perhaps once or twice per decade, globally. Second, the infrastructure, the $10+ billion invested in processing plants, pipelines, ports, desalination, and supporting facilities, cannot be quickly duplicated. Third, the permitting and social license. It took years to obtain environmental permits, water rights, mining concessions, and community agreements. Today's regulatory environment is even more stringent than when Escondida was developed. Fourth, the operational knowledge. 34 years of experience mining this specific ore body have generated insights about metallurgy, geotechnical conditions, and optimal extraction methods that new operations must learn from scratch. Fifth, the economies of scale. processing 422,000 tons per day of ore spreads fixed costs across enormous volumes that smaller operations cannot match. These 5 moats, geology, infrastructure, permits, knowledge, scale, combine to create an almost insurmountable competitive advantage. Even if a comparable deposit were discovered tomorrow, replicating Escondida's operational performance would take decades and tens of billions in investment. Looking ahead to the next decade, several key questions will determine Escondida's trajectory. Can BHP successfully implement the planned expansions on time and budget? Will labor relations remain manageable, or will prolonged strikes disrupt production? Can the mine replace reserves as fast as it depletes them? Will copper prices remain elevated or collapse if global recession reduces demand? How quickly will new copper mines in other countries come online to compete? Will environmental regulations tighten, increasing costs and complexity? Will water availability remain secure through desalination? Can renewable energy supply 100% of the mine's power needs? Will automation deliver the promised efficiency gains? These uncertainties are real, but the fundamentals favor continued strong performance. The deposit is enormous, the infrastructure is built, the expertise is in place, the market is desperate for copper. Barring catastrophic events, Escondida will remain the world's largest copper mine for the foreseeable future. No other project can match its scale, grade, and established operations. The global copper mining industry faces a stark reality. There are very few undeveloped copper deposits anywhere in the world that could match even half of Escondida's production. Most major copper discoveries occurred decades ago. The rate of new discoveries has slowed dramatically, and the deposits being found are generally smaller, lower grade, or located in politically unstable regions. This makes existing world-class assets like Escondida increasingly irreplaceable. Even if a new major deposit were discovered tomorrow, it would take 10 to 15 years to bring into production. Exploration, drilling, resource estimation, feasibility studies, permitting, financing, construction, each phase takes years. By the time new mines come online, global copper demand will have grown substantially. The supply deficit isn't a short-term problem, it's a structural feature of the market for the next decade or more. This is why BHP's $10.7 billion to $14.7 billion investment in Chilean copper operations makes strategic sense. Every dollar invested in expanding Escondida generates returns that new greenfield projects cannot match. The risk-adjusted returns favor brownfield expansion at proven assets over greenfield exploration and development. BHP executives understand this, which is why capital allocation heavily favors Escondida and other core assets. Here's the final piece most people miss. Escondida isn't just about copper, it's about the future of civilization. Every major technological transition in human history required access to specific materials at scale. The Bronze Age required tin and copper. The Industrial Revolution required coal and iron. The Information Age required silicon and rare earths. The Electrification Age we're entering now requires copper, lithium, nickel, and cobalt. Escondida sits at the center of this transition, supplying the material that makes electrification physically possible. When historians look back at the 21st century's energy transformation, this mine will be recognized as one of the critical assets that enabled it. That's not hyperbole, it's material reality. You cannot build an electric grid, electric vehicles, renewable energy systems, or data centers without massive amounts of copper. And you cannot produce massive amounts of copper without mines like Escondida. The financial value we've discussed, the tens of billions in revenue, the billions in taxes, the hundreds of millions in worker wages, all flow from this basic physical necessity. Copper is the blood in the veins of modern civilization, and Escondida is one of the heart chambers pumping it through. So when you see news about electric vehicles, renewable energy, or infrastructure investment, remember Escondida. That mine in Chile's desert is making those headlines possible. The $10.12 billion in copper it produced in 2007, the $13.6 billion worth it produces annually now. The hundreds of billions in potential future revenue. Those numbers represent humanity's electrification. The 1,055,000 tons pulled from the ground in 2023 will wire homes, power factories, charge vehicles, and transmit data. The 38 million tons produced since 1990 are embedded in the infrastructure of the modern world. And the 21 million tons still in proven reserves, plus the potential 28 million tons in resources, represent future progress yet to be built. This is why Escondida matters far beyond financial returns to shareholders. It's strategically irreplaceable infrastructure for the global economy. It's a critical node in the network of mineral supply chains that enable modern life. Its workers, when they strike, can move global markets because what they produce is essential. The next time copper prices spike on the news, the next time an electric vehicle company announces production targets, the next time a government commits to renewable energy goals, think about Escondida. That mine is the physical reality behind the aspirations, the geology, the engineering, the capital, the labor, the water, the energy, all combining to extract metal from rock. It's an ancient human activity, updated with 21st century technology and operating at 21st century scale to serve 21st century needs. And it all started with a hunch about super leaching and a drill hole that almost didn't happen. That's the story of Escondida. From geological accident to geopolitical necessity, from hidden deposit to global cornerstone, from drill hole number 6 to the world's largest copper mine. If you found this deep dive into mining economics fascinating, subscribe for more financial breakdowns of the operations that shape our world. Next time, we'll explore the economics of lithium brine operations in South America and why they're nothing like conventional mining. The numbers will surprise you.